Welcome back, investors, to Ticker Time News. I'm Adam, and stocks soared today, riding off their Friday's rally wave that these surfers were able to do. Now, we did in many stocks and the indices today tag the upper weekly expected move on day one. And typically, we know what that means. Either we have a ton of volatility in store for the remainder of the week, or we've already hit our high for the week. One of those two things typically occurs when it occurs on day one. So now looking at the S&P 500 just quickly here, it confidently breached its 200-day moving average today. Remember, on Friday, it did close a few points above that 200-day moving average. But today, it gapped up and just took off running like a racehorse down the track. That 200-day moving average on the ticker SPX is at 39.66. And then it closed well above the 4,000 level, 4,019, almost 4,020. Now, this is thanks to the belief of a potential soft landing for the U.S., for the U.S. economy. Now, I don't know why many investors are believing such facts, because fundamentally, nothing has changed. The Fed is still hiking rates, 25 basis points on February the 1st. That's what the probabilities are telling us. And then another 25 in March. And then the Fed will pause in March all the way through to potentially December. And December may be the first month where the Fed technically pivots and actually lowers rates. That's what the probabilities are telling us right now. And they're telling us that that probability of the rate hikes will pause at 5%. Whether you think that's a soft landing or not, market participants are believing that narrative right now. And the narrative was fueled by a Wall Street Journal article over the weekend by our friend Nick Timiraos, who, you know, is, of course, the, quote, Fed leaker, the Fed's preferred way to, quote, leak information to the public. Now, in his article, he was highlighting the probability of the Fed pausing its rate hikes this spring. Of course, February and March, for a total of another 50 basis points between now and the spring, along with a recent survey of businesses by the NABE that conveyed a lower probability, 56% versus 66% of a U.S. going into a recession. So that has come down. Interesting. But that's what fueled the markets today. And of course, Friday's rally was the starting point of that. It helped. Now, mega cap stocks, they were directional leaders today. Tesla, big time leader, up 7.7%. It was leading the way. And let me put Tesla up on the screen here, TSLA, right quick, and then we'll come back and go through the indices. But also remember, while this is loading, your questions are the most important thing about this live stream. So if you have them, put them in live chat. We'll go over them during the show. Okay, Tesla on the board. This is the daily view for Tesla. It has been in a very nice rally from an oversold condition. You see that nice pop today? There's a couple lines that need to load here. I'm not sure why they're not up here yet. Come on, there we go. The weekly expected moves. Now, Tesla does report earnings this week, so options market has some volatility priced in here as far as risk. The upper end of that is 146.93. Now, Tesla got up as high today as 145, so just a few points away from the upper end of the weekly expected move. Now, on the bottom side, it drops all the way to 119. I don't think Tesla would go that low. I think there's a lot of liquidity right here around the 120 mark that might prevent that, but who knows? Earnings are earnings, and sometimes we can get ahead of ourselves by rallying into earnings. So we'll see how that unfolds later this week, on Wednesday to be exact, and it's after the closing bell. Now, the Vanguard Mega Cap Growth ETF, ticker symbol is MGK, it was up 1.7%. And you compare that to the 1.2% gain in the SPY, and you can see that the mega caps were a leading directional driver of this market today. Now, technology up 2.3%, communication services up 1.8%, and consumer discretionary up 1.6%. Those were the sectors that led the pack, while energy was the only sector, it was the lone sector in the red. Semiconductors, they blasted off big time today and had a really strong day because of upgrades at Barclays. That drove a 9.2% gain in AMD, a 6.6% gain for Qualcomm, and a 6.4% gain in Skyworks Solutions. Now, notably, semiconductor equipment companies like Applied Materials, and which was up 4.1%, and KLA Corp, which was up 2.8%, they came along for the rally despite being downgraded by Barclays. So it was definitely a big day. I don't know what else to say. It was just a big day for everyone involved. All the stocks had a big day. Oh my goodness. It's kind of jittering at times to think about it. But I don't think it's going to last. And I'm going to talk about that in just a moment. While we're still on the topic of semiconductors, the Van Erik Semiconductor ETF, ticker symbol is SMH. It was up 4.7% today due to all of the semiconductor rallying. The semiconductor space rallying brought it up 4.7%. It's just incredible. And it did break through its weekly expected move big time. And remember, 68% of the time, by the time we get to Friday, close of business, we are right back within the range of the lower and upper weekly expected move. So whenever it pops out like that, especially on a big move, on a big day, you can typically expect by Friday it sinks back into that weekly expected move. And on the top side for ticker SMH is 234.85, and it closed today at 238. So another 4 points, it could fall to get back within that risk range there for the weekly expected move. Okay, despite this rally, this magnificent rally we had today, there was a pullback from session highs. The S&P 500, the NASDAQ Composite, the Dow Jones even had gains between 1.2% and 2.2%. Now, there was some short covering activity, and earnings season is in full steam ahead. We are in it right now. The Invesco S&P 500 Equal Weight ETF, ticker is RSP. It settled the session up 1.3% after reaching a 1.7% gain at its intraday high. Now, market participants also receive key economic data later this week, including the advanced Q4 GDP reading on Thursday, followed by the personal income and spending report for December on Friday, which includes the Fed's preferred inflation gauge in the form of core PCE price index. Now, let's look at the chart for everything that I just talked about. First up, on the daily, you can obviously make out that we hit that weekly expected move almost tagged it. For the ticker SPX, for the S&P 500, that is at 40.45. That is the upper end of the weekly expected move, and we got to 40.39 today. So a few points away from that. Now, on the lower end, that is 38.99. Now, if I show you here the year-to-date anchored VWAP, which runs across like this, we are way above that. Way above that. That is saying that if you purchased ticker SPX, the S&P 500, on the first trading day of the year, you are in the green. You have a profit, okay? That's the anchor VWAP. It's an average over time and the volume, all right? That's the first thing to note. The second thing to note is not on the big time frame, but we got to go deeper. But before we go there, up here, 30.62, This is the expected move for tomorrow, okay? Plus or minus 30.62 points. So we're sitting at 40, let's call it 20 right now. We drop 30 points, that takes us to 39.90. If we go up by 30 points, well, that takes us to 40.50, which is 5 points above the weekly expected move. Keep that in mind. All right, let's go down to the 15-minute time frame. This is where we need to spend our time looking at the charts, and I'm going to show you why it's going to all make sense. First, let me adjust this. Let me open this up and adjust it, and we'll do this for the SPY, the Qs, the IWM, okay? And then, of course, whatever else you would like to look at. Oops. Let me fix that and fix this. Okay, let's go down here. First things first. On the 15-minute time frame, you can see Friday's move, which, get the highlighter back. We have Friday's move starting here, all the way up until we hit this top today. And again, that top was at 40.39. Let me bring a few more days in here. Still in the 15-minute time frame. I want to bring a few more days in. Here they come. A few more days. And you're going to notice this parallel bars running across the screen. Now, I need to update this one right here. I need to change that color to blue because it's support. All right, now what I want you to focus on is going back to Thursday, which technically, I need to back that Sharpie up a little bit, which began right here with a quick sell-off and a quick rebound. But on that day, that's when these two lines right here started, okay? And you can see we tapped out right here, Thursday, January the 12th. We tapped out again right here on Tuesday, January 17th. We tapped out right here on Wednesday. I'm sorry, Tuesday, January 17th, if I didn't say that. And then we tapped out Wednesday, January 18th. And then look at what we did today. We tapped out at that exact line there today. So what is this telling us? Well, let's also look at that bottom line, okay? It started with a gap down and breakthrough right here. And this was on Friday the 13th, good old Friday the 13th. And then we broke down right here again, breaking through, but this time we meant it. And we went all the way through, mainly because we were disconnected from our 5-day EMA. We reconnected with it right here, okay? If you look at us right now, today we started, or I should say Friday, we started down here, connected. Now, what are we? We are disconnected from that 5-period moving average. So this is telling me two things. Oh, one more thing I need to point out. Today, we came down and we tagged it. We didn't break through. We were able to pull ourselves up and bounce from that in the afternoon trade. The sell-off was quick and sharp when it happened, but it found support here. So if this is going to continue and support is going to hold, that shows us that there's a path forward to continue moving higher. Interesting. One other thing to point out, and it's more so on the daily view than just here on the 15-minute time frame, but I'll show you where the line is. It's this red line going across the screen here, okay? I know it's hard to see. I've got too many lines on the screen now, getting it all cluttered up. This line was our 2022 and 2023 downsloping trend line that has stopped every major rally for over a year. We broke through that today with the most extreme punch through it in over a year. Now the question, will we get follow through and hold the line? Because I'm telling you, something doesn't look right. It's not adding up. All right, let me clean off the chart. I want to show you the SPY next. And this should give you something to think about in terms of, are we really going to go much higher than where we are right now? I'm not so sure. Okay, so the chart that we need to go to, let me just get these two other marks off. I'm going to go to the daily view to demonstrate this. We're going to go to HYG. That's the ticker. HYG. Okay. Now, HYG are your long-term bonds. This is considered quote unquote smart money. And the SPY is considered quote unquote your dumb money. Smart money versus dumb money. Whenever there is a divergence between the two, it's typically HYG leading the SPY, whether that's moving up or moving down. If you look at the HYG today, and I need to adjust the 5-period moving average since we're on a daily time frame. If you look at today's candle, it does not look anything like what we saw from ticker SPX for the S&P 500. HYG was flat today. Flat. The SPY was up 1.2%, but HYG was literally flat. Last Friday, it was up 0.2%. This is leading the SPY. So what do we have here? Well, if we take a look, we don't really have a set of lower lows, but we're moving sideways. Moving sideways, okay? Now, keep that in mind. Moving sideways. Now, let's go look at the SPY. Remember, quote unquote, smart money versus dumb money. Look at this. The past 3 sessions for HYG were moving sideways. The past 3 sessions for the SPY, rocketing to the moon. We have a divergence between HYG and SPY. And the HYG, 99% of the time, leads the SPY. So, have we reached the top then? Are we about to roll over? This big momentum push through the downsloping trend line that stopped every major rally for over a year that got punched through today. Are we going to fall right back through tomorrow? Now, remember, HYG, what did that look like? The past 3 trading sessions, we had the sell-off, and then from the sell-off, HYG moves sideways. HYG leads the SPY. Flat. Up 0.01. Actually, technically, it is a penny off from open to close there. Now we go look at the SPY, and the SPY for the past 3 sessions since the big sell-off from Wednesday and Thursday of last week have been runners. So what HYG is telling us, we're at the top. We're going to pull back from this. It may not be tomorrow. Maybe it's Tuesday, Wednesday, Thursday. Maybe there's some significant earnings that messed things up. Microsoft is reporting this week. I mean, there's over nearly 100 companies reporting earnings this week. Tesla is a big one too. So the observation is HYG is telling us that, yes, today was a big day for the SPY in all the different companies and sectors in it. But that big run may be done. Okay, let's keep going on here. Let's go to the 15-minute on the SPY, so I can show you what I did for ticker SPX, because we've got the same thing here. Okay, let me adjust this chart right quick, open it up so it's easier to see. Yeah, today was a great day for everyone who had longs, who had calls out, even calls from Friday. Man, going into the day and leaving them open, you did very, very well. Very, very well. So our job here is to dissect what happened, why it happened, and what to expect. We've already dissected what happened and why it happened. Now we're dissecting what to expect. Look at this. Just like on the SPX, okay? We have this resistance line right here. All right, let's go, highlighter. Right here, it stopped the SPY. Stop the SPY. Stop the SPY. Stop the SPY. And then today, stop the SPY. We have overhead resistance not too far off. We can't get caught up in thinking that we have enough velocity to get out of the hole that we've dug with this rally. To me, this is still a bear market rally because nothing fundamentally has changed. If anything, it's gotten a little worse. But we have rallies, and that's cool. All right. But we have to be realistic, okay? We can't be optimistic or pessimistic. We got to be realistic. And that's what this right here is telling us. Now, when we go back to the daily here, right quick for the SPY, got to adjust it. Let me bring it down. We're also in this, well, we were. Today, obviously, this could be a one-off, right? Because if you look at the different times when we've punctured the downsloping trend line, here, the wick tagged it, and that was it. Then we break above it, but we don't close above it. We really break above it, but we don't close above it. Then today, we break above it and close above it. So we've been doing a little bit better each time. Over the past 4 times, we've run up against this resistance line. Okay. Thinking that we're going to continue to run up, I don't know if that is totally possible with what the evidence I just showed you, especially comparing HYG to the SPY. It's a leading indicator. Okay, let's go to the Qs real quick. I see you guys are doing awesome. Absolutely love it. Meta paid me great. There were a lot of good moves. I had longs from Friday that I let roll because we weren't back up to that resistance, that hard downsloping resistance. And they paid real nice today. I did close them this afternoon when we started to sell off. And in that sell-off period, I did start to open a couple of short positions, to be honest. All right, now that downsloping trend line on the Qs, it's never been breached. All right. The last time we tried and came close was here, which was the December 13th low. That was the low for the S&P 500, right? But not so much for, I'm sorry, this was December. I saw the D and I thought it was an O. Oh my goodness. I can't spell. December 13th, that was the last time we tried to get it. And then today we did break above it. We did close above it. Okay. Now let's go to the 15-minute. And this is even more solid than I think the SPY is. With this, we've hit the top. Because at least the SPY pulled back this afternoon substantially more so than the Qs did. Okay. Let me pull a few more days in here. This is the 15-minute time frame. And I'll get the 5-day EMA brought back in here. But there has been this trading channel, okay, going all the way back to, is this the 6th? Friday the 6th of January. We've got this trading channel here, okay? And in this trading channel, there's the 5-day. I just put it on the chart. In this trading channel, you can see here, we broke above, but were rejected. The first time right here, okay? And then we tried again here. We tried again a few times here. Tried again a couple times there. Tried again a few times right there. Tried again and tried again and have been rejected off of this line every time we have tried, going back to January the 6th. Okay? So for the majority, or at least half of this month, we've been fighting this resistance line on the Qs. Now, there was a support line down here that held up the Qs, but we are not near that right now. So for the Qs, I'm thinking, uh-oh, the Qs are in trouble with this resistance. Okay? The Qs are in trouble here. All right, let me change that to red because it's resistance. Now, the Qs did break above, like we saw on the daily time frame, that downsloping trend line. Okay? It did not find support along that downsloping trend line. It did bounce a little bit before pulling back that far. But what the Qs did was break above the upper end of the weekly expected move. The Qs got to 290. The weekly expected move on the top side is 289. So the Qs broke above the upper end of the weekly expected move by 1 point and then pulled back from there. Because remember, 68% of the time, by the time we get to the end of business on Friday, the equity, the index, whatever the product is, closes within the upper and lower weekly expected move. Again, 68% of the time. That's a really good win rate. So a lot of times when we get to the upper end of the weekly expected move, which is this purple line here, and then the lower one is down here, and the lower side is 275. Once we tag a weekly expected move, if we break out, we typically come back in. Same thing if we're on the bottom side. If we break down, we typically come back up by the end of business on Friday. That's why it's a weekly expected move, where the market should be by the end of the week. So here we are, day one, tagging the upper end of the weekly expected move. Now, it typically means one of two things. Either we're just going to trade sideways now, or we're going to have a really volatile week. That's all we need, is another volatile week. We've had enough of those. Now, it would be nice if you are bullish for us to move sideways or continue to push a little bit higher. But if you look at the RSI on the 15-minute time frame, let me pull this down here so we can see it. I mean, it's only out of 56 when we close today on this 15-minute time frame. So it has cooled off, but is that enough? I mean, 56, that's nowhere near 30, nowhere near 70. It's right in the happy middle. But running up against the upper end of the weekly expected move and that resistance line that has slowed the Qs down for the past couple of weeks is no joke. All right, let's go back to, let's move on. Let's go to the IWM, and then I'll make sure to pull up your comments and what you got here. Definitely a great trading day. Definitely was. Okay, 15-minute time frame for the IWM. Let me bring this down a little bit. Now, for the IWM, something interesting is it has broken above that downsloping trend line, which runs right through here, okay? And right through there. Now, the last time, it just messed around for a couple days at it. It broke up real high, and then it came right crashing right down, all right? Today was a little different because it broke above, right? It broke above, and then during the pullback, it tried to find support on that line. It got a little bit beneath it, but it did bounce from there slightly. That is a little more of a positive setup than what I think we have for the SPY or for the Qs at this moment in time. Do remember the market is fluid, so things do change, and they can change rapidly. All right, let's go to the daily time frame for the IWM. All right, the weekly expected moves here. Let me get this right. The upper end is at 189. The lower end is 180. So a potential 9-point move for the week. And again, that's plus or minus to get to those 2 points. So today, we are right here. We got to a high of 188, 189, and 188. 189, the weekly expected move. Briefly got above that to 190, 1 point above for a brief time period, and then we pulled back. Now, there is this ascending trend line here on the bottom. So I find the setup, at least for the IWM right now, a little more favorable. However, we do have to remember that this is the small caps. Small caps have been lighting off left and right with big moves, really big moves. Okay, let's get into your question. So just to kind of sum it up here, we are at points of resistance on the smaller time frames, 15-minute, 5-minute, for the SPX, the SPY, the Qs right now. Does that mean then tomorrow we could see it pull back? Well, I think Tuesday or Wednesday for sure. I think it pulls back. Looking at the zones, which is something that we're working on, we share with our private investor community. We shared it with them yesterday, last night when we published the weekly expected moves. And right now, the zones are they're starting to turn red again. Okay, they're starting to turn red again. We have the SPX and we have the SPY. They're in the 80s, so they've started to turn red. We have the Qs at an 90, upper 90s. That's a bright red. That is looking to pull back. If you're in our private investor community, you know what I'm talking about when I say these colors. We also have, looking at the sectors, XLK, which is technology, in the 90s, bright red. We have XLC, that's your communication. That's in bright red. It's in the 90s. And then we've got semiconductors. SMH, it's in the red, bright red. It's in the 90s. And then last, TQQQ, which is a leveraged long position on the Qs in bright red. And whenever we get bright red, it's a warning signal that says, hey, these products are at the top of their range, and a pullback or a move sideways is incoming. Okay. Meta paid me great today. Yeah, Meta did good. I don't think there are many that I could go through on the chart and pull up that didn't do a good job today. I mean, there were a lot. It was another good day, like Friday, where a lot of companies did really well. Okay, let me just adjust this right quick. Okay. Meta, its upper end of the weekly expected move, 145, lower end, 133. It just kept marching today, and Meta's been performing really, really well. It had its little sluggish slowdown here because there was prior resistance right around that 135, 136 area. That was foreshadowed. That was known to be coming. So Meta did really good. Who else do we have up here? Snap did good. Yeah, social media, all of them. Apple did really good. Yeah, let me pull up Apple, AAPL. Get the ticker over here. There we go. Apple did good, but I have concerns about Apple. Not necessarily technically on the chart, even though there are some concerns. The fundamentals for Apple do have me concerned about, where could it be headed, right? It got above that downsloping trend line, broke above it this morning, closed above it. 141.93 is the upper end of the weekly expected move. The wick broke through that today, pulled back. It closed at 141.11. So it's up there. RSI is at a 94. Not too bad. So again, once things get to that weekly expected move, they tend to slow down once they're above it. But yeah, Apple did tremendous here. Yeah, great trading day. Absolutely. I see you there. Be big. Let's pull that up. BBIG. And I don't think I've looked at this chart in a while. Interesting. Interesting indeed. Let's see, where did this thing come from? The overall trend is definitely down. The old adage about the 200-day moving average, nothing good happens under the 200-day. It's had some rapid moves. Need to adjust the 5-period moving average for the daily time frame. Okay. So overall downtrend here, and then let's get a closer look. I know the chart goes all over the place when I'm trying to resize it. Up 5% today. That's pretty cool. Let's see. Let's open this up. Let's pull you up. There we go. All right. So it looks like I looked at it about a week ago or so. So this trend line here, we can adjust it a little bit now. We've got a little bit more data on this thing. So if we adjust that trend line, okay, you can see it's pulled way ahead of that trend line. It is over its 50-day moving average. It's connected with its 5-day moving average, so that circuit is flowing. So it's good that it found support on Friday at that 50 period. And then today moved that 5%. But it does have resistance right overhead, especially around the 72 to 73. 72 maybe to 74 cents. It's definitely got overhead resistance there, which is right about where this blue line is right here. So if it does move any higher, I'd expect it to be rejected off that. If not, it could continue a move down if we just tag all those, because they line up nearly perfectly. That's not looking good. That's short term. It looks like we might be setting up a symmetrical triangle, which can break over either way. But that's a sharp decline there. That's real sharp, and it could just push this thing right through that support system there for it. And if I drag this old support over just a little bit further, right there, it's going to come in contact with this point here in just let's see, 1-2 days, and it's there. So there's going to be a decision made here within 1 or 2 days on which way this is going to continue to go. Probably it'll continue its way down, if I'm having to guess here. Awesome. Glad you're here. Glad you're here as well. Okay. Well, if you do have any other questions, plug them in now. Otherwise, I'll go ahead and wrap the stream up for today. It was Monday. It was a big day in the market. A lot of green everywhere. Unfortunately, it seems to me like things are at interesting points where they could very easily come down from where they are, right? If you're looking at the 15-minute time frames, a lot of the indices are up against resistance. And let me just use one stock here. I'll use Apple on the 15-minute time frame so you can see this. Apple's had a nice steady run, 2 big powerful moves today, yesterday. The body of the candle today, you've got a lot of wick up top, not much of a wick underneath, okay? So that means there was a little bit more overhead selling pressure pushing Apple back down, but it did hold up good, and it had a real nice day. Apple being up 2.3% is a good day, a really good day for Apple. Okay, now Apple was trading in this trading channel, okay, on the 15-minute time frame. Let me adjust the top resistance. I'm going to extend it out and keep it lined up. with where it was right there, and then the support line underneath. Let me bring this one out a little bit more, keeping it lined up. And you can see there for Apple on the 15-minute time frame, today it found some resistance once it broke that trend line right here. And then once it broke above to the upper end of the weekly expected move, getting up to 143. And then when it came back down, it didn't find support at that trend line, that old resistance. It fell right through. So if you're looking for strength, a lot of times when you see something push through like that, when it comes back down to back test it, you want it to bounce off of that. And a lot of times that can be your entry point. TLT did that over the span of about a month's time. It broke through a long-term resistance line. It came back down, back tested it, and it bounced off of it. Old resistance became new support. So that's what you'd want to see. Apple break through, come back, test it, find support there, and then bounce higher. And then that can be used as an entry point because that's showing some good strength. Now, it's back under. It has broken down. Where is the 5-day moving average? Okay, so it's been disconnected. We got to go back to Tuesday. So it's been disconnected here for several days now. So to me, this is just it's showing that it's extended. All right, let me go to the daily right quick, because I also want to just put the zone on here. Let me just bring this back down into focus here. Open it up some. All right, now I want to put the zone on for Apple. It's at the top of its zone right here. It looks like it did pierce it just a little bit today. Yeah, that wick definitely did pierce it. And once it breaks out of that zone, whether top or bottom, it can be a good time to start loading in to go the opposite direction. Just the most recent times it broke loose was right here. It broke out to the downside. So going the opposite direction would be taking a long, and that definitely worked out. Definitely worked out. Back here, it broke out, going the opposite direction. Going long, that would have worked out real nice. So a lot of times when they break out, I mean, here too, going the opposite direction, I mean, you would have been able to pick up something there. That would have been good. Now, if we go here, it broke out, and then it just went sideways to get back inside. So that would have been a wash. Another breakout, it went sideways. That would have been a wash, right? Or maybe you could have done a day trade or a 2-day trade and possibly gotten a tiny little something out of that. But then the other thing to consider too is when it was up here, let me bring this down a little bit. When it spent several days on the outside, that's when you start building a position to go in the opposite direction. You add a little bit more each day, and then eventually you'll get it to flip in your direction, and it works. So this is custom math that I have on these zones here. It looks like a Bollinger Band, but it's not. The math is completely different. So this is something that I follow. It goes out into the zones that we send out, that we're working on to our private investor community. Yesterday, for example, it went out, but that was showing the market in a more neutral stance where you could have gotten the big rally. But now that we got a big rally today, a lot of the indices in XLK, for example, are starting to light up red again, meaning a pullback in those is incoming. So XLK and the Qs have it more so than anybody. Let's go to the Qs just right quick, since I have the zone here. It broke out just barely. The wick went a little further, but the Qs are, in my view, they're a bit overextended here. They're on the top side of things. The Qs will pull back, in my opinion. If not tomorrow, then on Wednesday. Let's see here. What happens if earnings aren't that bad? Okay, so what the market has to do right now, because earnings are not great. Earnings are not great. You do not have bull markets. What is it? I wrote it up last Saturday. I believe it was last Saturday when I wrote this up. That earnings right now, what, they're 17.5, 17.3 times right now. You don't get bull markets when you're that low, right? You have analysts who, over the past several months, have lowered their expectations for earnings. And then you have companies who aren't beating those earnings, or they're barely beating those earnings. And for a lot of market participants who don't take into account that, hey, wait a minute, these earnings have come down over the past, 2 or 3 months, and then the company just barely beat those. So if analysts would have left their estimates alone, the companies would have performed really bad on earnings instead of just a little bit on the good side. Okay, so there's multiple things to understand when it comes to earnings like that. So with the market participants out there who, for some reason, and I don't quite understand why, think that, oh, the Fed is going to become dovish all of a sudden. No, we've been talking about this now for 2 or 3 months. You guys who have been on this channel with me know that I bring it up all the time, and I've been talking about it for months. I said no way the Fed was going to stop raising rates until 5% or more. I was talking about that last September. I said no way the Fed's going to stop raising rates in 2022. They didn't. We've said for months, the Fed in its February, March meetings, a 25 basis point rate hike. Looks like that's what we're going to get. The probabilities also say that exact same thing. The probabilities say the Fed is going to hold that 5% rate all the way through until 2024. Maybe the December meeting, they lower the rates. Economic data is getting worse. It's not improving. We're in the contraction phase. To me, I mean, just also think about this too. At the beginning of December, the middle of December, everybody was bearish. Remember, oh, I forget what episode it was. We talked about, are we so bearish that it's actually bullish? Remember that conversation? Well, the market's been on a nice little run. We just got overly bearish to the point. So many puts here and there. I mean, I remember showing that image of the put call ratio, and it had spiked. When everybody's going in the same direction, sometimes the best thing to do is to run in the opposite direction. Everybody thought the market would be headed lower, like right now, headed lower. Like there's no rally incoming. We're just going straight down, straight down, straight down. Well, the market doesn't move that way. So when we do get overly to one side or the other, well, look the other way. Well, I don't mean look the other way in that sense. I mean, go in the opposite direction. So here we are. Everybody's excited. Everybody's bullish. Everybody sees the same things that we see on the chart. But now the narrative is shifting. The narrative is shifting where everybody is going to start placing calls and betting on this market to go further, to go higher. This, I think, is when you start to either FOMO along with it, with other market participants, and see how far it can go, or you take the cues that are out there and you start going in the opposite direction, even if it's just a little bit, right? I put some shorts in today. I don't know that the market's going to fall tomorrow, but I do think it's going to fall. We're going to have a down day. Maybe tomorrow, maybe Wednesday. So I did get some shorts in because we are moving up there. We've had several days in a row. Well, 2 big days in a row, Friday and today. You take out last Thursday and Wednesday, and we've got several good days in a row. We've been in a nice rally here. We've finally, looking at the cues here, broke through and closed above the downsloping trend line that has stopped every rally for over a year. So here we are. Now it looks like we are at the top of the range. Remember, the ranges are fluid. They change as the market does, but right now they're telling me that they're getting a little overextended, and either we'll get a pause as the market moves sideways, or we're going to get a pullback. So just using the data that you have to the best of your ability. Now, when it comes to earnings again, earnings are low, right? This is a very subdued growth rate for earnings. We are under the 5-year and 10-year earnings averages. We are under those. That's not good. That's not what you want to see if you want the market to enter a new bull run, right? You don't want to see us below the 5-year and 10-year averages on earnings. The growth is better than what we saw in December, but again, it's under those key averages. So we'll see where the market will go from here. I don't know. After looking at the Qs, what do we have? A 2.2% day today. Friday was a 2.7. So what, a 5.5% move in 2 sessions? That's pretty quick. That's pretty quick. It'll definitely be curious to see when big tech reports their earnings. We get Microsoft this week, Tesla this week. We got Netflix. Netflix did good, and of course, its stock soared off of it. As a matter of fact, NFLX, how did it do today? Another big day. Oh, it's way, way out there with this move today. 4.3% move, way above. Oh, look at that. Day one closed right on pennies. It's literally about 50 cents off of the upper end of the weekly expected move on day one. It's outside of the zone big time. Like the candle's not even touching the zone. Wow, that is something. Very, very interesting there. I mentioned last week about it being up and thinking, oh, no, this thing, it's curling over. It did come on down some more, but Friday was a big move. Today was a big move. I just can't see us getting more. Now that we're first day of the week, we're at the upper end of the weekly expected move. This thing will probably just move sideways or pull back down. I can't see it going too much further there. That's just incredible. Okay, back to a ranging bull market. No, I do not think we are in a bull market yet. I don't think we're anywhere close to a bull market yet. Just because we're in a rally, just because we finally, after over a year, broke through the downsloping trend line, I don't think we're in a bull market yet. Not at all. Yes, we've made some ground since the low on October the 13th, but this is not a bull market here. Not when you have 2 big green sessions, and then you have 2 decent size red sessions. So I mean, we're still bouncing around right here. The market lacks conviction, and then it suddenly finds conviction to rally today and on Friday. But yeah, let's see if there's follow through from this, right? If we get from a move like Friday and then today breaking above that downsloping trend line, if we get follow through Tuesday, Wednesday, Thursday, Friday, then we've got mounting successes that are building, which of course will then put us in and overbought territory if something like that happened. But watch for follow through. See if it happens, right? We can't just jump to conclusions when earnings aren't that great right now. And yeah, everybody started back over at zero at the beginning of the year, but last year brought us down significantly, right? So there can definitely be some more bottom to us, to this. It's so hard to see us breaking to the upside into a bull market, but everything seems to be jolly to the market right now. Yeah, everything does seem, market participants seem filled with hopium, definitely filled with FOMO when it comes to smaller caps, definitely. But nothing fundamentally has changed since last Thursday when we pulled back, since last Wednesday when we pulled back over 1.5%. And just got to remind yourself of that sometimes. It may feel like you're wrong because the market's going in the opposite direction that you think that it should be. But if nothing has changed, well, then you gotta wonder. All right, here we are. Fed Watch tool. What's the rate hike gonna be on February? We have ourselves a 99.4% probability of a 25 basis point rate hike. Okay, nearly 100% probability that we're going to get that 25 basis point rate hike. Let's go to March 22nd. Okay, March 22nd, there is an 85.1% probability of a 25 basis point rate hike. So 25 in February, 25 in March. And then we're at 5% for the Fed funds rate. All right, let's go to May. Let's go to May and see what that probability looks like. We have a 58.1% probability that the Fed pauses, that the Fed does nothing, that the Fed holds at that 5% rate. There's a 32.6% probability that the Fed takes it up another 25 basis points. And then there's a 9.2% probability that the Fed either held rates in February and then raises them by 25% in March, or that the Fed lowers them by 25 basis points for March. So I don't believe this is for lowering. I think the probability is that 9.2% probability is that the Fed paused on the March rate hike or maybe the February rate hike, and the Fed needs to take it up by 25 basis points because they paused for a month and then they realized, oh, we can't pause yet. We need to keep going a little bit further. So this is what it's looking like. And then we can go all the way out to, I'm going to go out all the way out to the November 1st meeting. And if the Fed held at 5%, the November 1st meeting shows a 34.4% probability that the Fed cuts the rate by 25 basis points. We have to go all the way to November 1st to find that highest probability. Otherwise, it holds at 5%. And then December, if we got to 5% and we held there, now we've got a 32.6% probability that we bring it down by 25 basis points. So what the probabilities are telling us is that February 1st, a 25 basis point rate hike. March 22nd, a 25 basis point rate hike. Hold all the way to December the 13th, and then lower them by 25 basis points. And it's holding through the June meeting, July meeting, September meeting, November meeting. So for 4 meetings, it's holding its rate hike, the Fed funds rate, at 5%. Now, market participants are getting all excited because the Fed is going to pause, but literally nothing has changed. These are the same probabilities when we go to February 1st that I've been showing you for a month now. Since the last Fed meeting, we've been looking at these. Since the meeting before, we look at these every so often, and the numbers as far as the top probability, what the majority plus has said, has not changed. If anything, looking at the February 1st meeting, which is literally around the corner, the probability for the 25 basis point has only grown stronger. So nothing, absolutely nothing has changed with the Fed. Yet the narrative out there is some sort of misconception that the Fed is going to pause rates won't go as high. Yes, nothing has changed. I don't know how many times I have to say it, but there's some disconnect here between what the Fed is going to do and what market participants think the Fed is going to do. And they think something's changed when nothing has changed. Maybe market participants look at the probability chart and they notice that, oh, wait a minute, this 99%, 99.4% probability a day ago was 99.3%. A week ago, it was 93.7%. A month ago, it was 65.9%. Maybe they see that the probability numbers keep going higher and higher and higher, but for the exact same 25 basis point rate hike, that they get confused somehow and thinking something is changing when absolutely nothing is not. I'm sorry. It just gets me all riled up. When I see these stories about the Fed this or the Fed that, when nothing's changed. Okay, I am just going around in circles here. Oh, great point. Great point here. Is it wise to start putting my US dollar into another storehouse of value if the rate hikes don't work out, like gold or silver? I firmly believe in a portion of your investment, it should be in physical gold. I don't talk about that nearly enough, but I do believe everyone's portfolio, whether it's 1%, 10%, whatever the number that you're comfortable with, should be with physical gold that you can touch, hold, feel, look at. Absolutely. Absolutely. That one's a no-brainer for me. And it doesn't matter what rate hikes are doing, okay? And remember this too. Let me put it up here. Where is it? I show this chart often, right? Leaving 2022, I figured that we were at the tail end of stage 6. And entering 2023, we were at the very beginning here, going from the last stage of the cycle, stage 6, to the beginning stage, stage 1 of the cycle, sometime right now. Okay, this transition is happening right now. Okay, we just started in December to get our economic prints that show, and I should do it in red to be consistent here, that shows contraction. All right, and contraction is when we are going down. Okay, our economic reports, a lot of them are based on like a 0 to 100 scale, right? 50 is that cutoff number. 50 and above, and it's growth. The further you get away from 50, the closer you get to 100, the faster you are growing. Once you get to 49 and below, you are contracting. And the lower that number goes, the faster you're contracting. So for December was the first month that we actually got some type of contraction in some economic reports for the first time. Others, they've been in contraction now for a little while. And in stage 1, what does best, and I'll do it here in green, is bonds. What does the worst? Commodities and stocks. Okay, so we are not out of the woods yet when it comes to the stock market. I do not believe we are going into stage 2 right now. I think we are going into stage 1 right now. Now, when here on this sector rotation here with stocks, commodities, and bonds, it says bonds go up. Well, what's a good one we can use? Well, TLT is one that we can use. This is your long-term corporate treasury, 20-year plus treasury bond. Okay. Now, when we look, the long-term downtrend line, as soon as it loads here, you will see that it was broken, right? And this is what I had mentioned earlier. TLT had broken its long trend resistance line. For over a year, that line had stopped every rally. This was the first time it broke through. And then it pulled back down and it back tested, and it found that old resistance is now new support. And it rallied nicely. It has pulled back because, like everything, it doesn't go straight up. So it has pulled back some, which is fine. It's all good. So this is an example of something that in stage one will typically outperform stocks and commodities. Okay. One more thing. Let me just go ahead and pull the dollar up since we're talking about this stuff. This is something that is a little odd and a little out of place compared to how things have been for nearly a year when concerning the dollar and the S&P 500. For about a year, when the dollar would go up, the S&P 500 would go down. And when the dollar would go down, the S&P 500 would go up. Well, that correlation, that inverse correlation, seems to have been broken. Okay? This is now the dollar that is, it's broke below my 102.5 level that I said if it did, that's when I consider the dollar to be done. And since then, it's been ticking slightly lower, but it's had its green days. If you look at today it was up, I mean, only 0.02%, but it was up. It was green. The dollar was in the green today. Not by much. But the S&P 500 was in the green too. Now, the bigger the rate of change for the dollar, the more pressure is put on the S&P 500, whether up or down. So with the dollar going up even just a little bit, that should have applied some pressure to equities, but it did not. So this seems to have either broken or it's starting to break, because this isn't lining up with how it's been for almost a year. Almost a year, not quite a year, but almost. So something else that I want to bring up there too. Let's see here. Oh my goodness. Where are we here on your comments here? Okay. Aren't there any investments in shares of companies that will not be affected by the rate hikes? Well, I mean, you could go into the first thing that's popping into my head are potentially miners of precious metals. That could be a group. The problem right now is that we're in a transition. And whenever you're in a transition, things can get a little wobbly and loose. Okay? If the Fed pauses, like I think it's going to, with its rates, and there's some stability, even though rates are up, but there's some stability in rates because they've paused, I think banks might actually start performing well if there's stability with rates. The only thing that we'd have to be cautious of then are delinquencies and then non-payment. You can go, you can trade gold without having the physical asset. That's a possibility. I mean, look at how strong gold has been since November. November all the way through today. The weaker the dollar gets, the stronger gold will get. If rates keep going up and if rates stay at that 5% level for a year, that's beneficial to gold. And then a recession on top of that is also beneficial for gold. So all around, I mean, look at gold. It's at $19.34 an ounce. Back in November, gold was all the way down here at about $1,600 an ounce. And since the beginning of November, gold has been performing very well. And I think it will continue to perform very well. Okay. Can you remove the chat comments so we can see bottom of the chart? Oh, yeah, my apologies. My apologies. I leave them up there and then I forget that they're blocking the screen. Oh my goodness. Absolutely. I hate being out of the market. I guess I can read it and then move it. I hate being out of the market and not being in some growth companies. Yeah, that makes sense. The thing that I'm seeing right now, over the past week and a half, your small cap, no profit companies have gone through a short squeeze cycle. And it's at the end. It is at the end. It can't last forever, right? So going into those type of growth names, I don't think are your best bet. But I don't know your exact situation. That's why this isn't financial advice, because everybody is different, has different goals. They're want to do different things with their money, on like being more conservative to a little more growth oriented. Pick, and if you're investing I mean investing in the total sense of the word, for 5 years, for a decade or more, buy the companies you think are great. If you believe in Apple, buy Apple. If you believe in Tesla, buy Tesla. Do it on their next pullbacks. Because on the longer time frame horizon, history says that you won't be wrong. And when you look at how discounted things are right now, I mean, I'll just use the SPY for a quick example, okay? You don't have to trade, okay? Trading is not it's not required. Some people like to trade because it's fun. Some people want to trade for the experience of finance and so forth. Some people want to trade to make money. But if you look at the SPY here, over the past 1 year, 1 year ago today, the SPY is down 10%. So buying in now, you're buying the SPY at a 10% discount to its price from 1 year ago. So if you are investing in the true sense of the word, buying and holding, don't worry about what the market is doing day to day, week to week, month to month. Dollar cost average, just like you would in your 401k. Do it consistently, and over time, you will win. Sure, you may have missed the bottom of October the 13th on the SPY, if that was the bottom. Maybe it's not. Nobody has a crystal ball. Maybe where we're at right now, maybe this will end up being the bottom for 23, and maybe 2023 will be a better year. But if you're just truly investing and you don't want to do the day-to-day trading aspect, that's fine. You don't have to. And there's nothing wrong with that. I know we talk a lot about what's happening day to day and which way the market's headed. But over time, investing, dollar cost averaging, these things have worked and they will continue to work. Diversify, not just in different companies, but different sectors. Like, don't go all in and, buy 10 different companies in technology. Buy a couple from each sector, okay? Buy 2 or 3 from each sector. You'll be somewhere around 30 stocks. That's good enough. That's diversified good. Have some physical gold as part of your investment, and have some Bitcoin as part of that diversification. And if you don't want to pick individual stocks and individual sectors, then go with the SPY. Go with the S&P 500 ETF. And just make sure that you are consistently and precisely investing on a routine. Same amount or more every 2 weeks, every month, whatever your timeline is. And it will work out. I don't want people to get caught up in the day-to-day of trading and what's happening in the market and miss out on the bigger picture. Because it does take a lot of stress away. Instead of worrying about trading day to day. Okay. I hope that helps in some way. I'm going to sell calls on SoFi. Where is SoFi? I don't think I've seen SoFi in a while. SOFI. It's just like the other short, small cap companies. It's had a nice run. I can't believe this thing was all the way down into the $4. That's incredible. It tagged that 200-day moving average, it looks like, or came really, really close. It's coming into an area of overhead supply. Are you joking about doing calls up here? Oh, selling calls. Okay. It looks stretched up there. It really does. 72.4 on the RSI, which is overbought. It is overbought technically up there, and that is a big stretch that's been on. Earnings in 6 days. That'll be interesting. All right. Well, I'm going to go ahead and wrap it up here for tonight. I want to thank you so very much for being with me every evening. I greatly appreciate your company and you joining me. I'll be back here tomorrow after the market has closed to talk about what happened, why it happened, and what to expect going forward. We go live between 7:30 and 8 p.m. Eastern. And with that said, have a wonderful day. Good luck in the markets tomorrow, and I will see you in the next video. Good night.